All right, everyone. Hope you guys having a great day as always on this weekend. We have our guest speaker with us. By the way, in the description, you'll find links to read further of his work. So the discussion today will be rather overarching, and then we'll focus in on a couple stocks here or specific names, in particular SoFi. But I guess I'll start off with Gary. Go ahead and introduce yourself to the audience. Let everyone know who you are, what you do, etc.
Okay, thanks. My name's Gary Gordon. So I had a career on Wall Street. I was a sell-side stock analyst for actually a couple of companies that no longer exist. EF Hutton, Payne Weber. We got bought out by UBS, which is still alive today. Retired about 15 years ago, and now I'm actually working as a college professor, teach economics and math.
So you're somewhat familiar with the topics we're about to be discussing, you would say.
I hope so.
A fellow New York State worker.
There you go.
So I would start with the first question and getting right down to it. Oh, by the way, audience, if you see the poll question, go ahead and answer that, and we'll kind of get that towards after the third question answered. But how do you describe your investing style? Like, how would you say it in your own words?
To me, very much a value investor. In my mind, I work at identifying what I think is the fair value of the company. And then if the stock is materially different from there, I can buy it or sell it. So first, I've got to get comfortable that I have some idea of the value of the company.
So do you usually incorporate, is there any sector in particular that you're adverse to, or it's anything and all as long as you can understand it?
Well, I say at this stage of my life, I told you my background, so I feel comfortable investing in those areas, housing, maybe banking more broadly, consumer lending. But outside of that, I really don't personally invest. I invest with others. I have various stock funds I invest in, real estate, et cetera, fairly diversified. So I'd say about a quarter of my money is invested in my own ideas, very concentrated. I've got two big ideas that I'm focused on.
So okay. You would say your individual stock picking is things within what you feel would be your core competencies, would you say?
Yes, by and less. It's just energy. I'm not, I learned myself that it took a lot to learn enough about my area to get really comfortable. And I'm not sure I could do that in healthcare or technology, et cetera.
Well, technology, we're going to get into a little bit about that later.
Mm-hmm.
So, Dan, you got a question for him?
So how would you describe, like, in general, analyzing banks? Would you consider them more or less difficult to analyze than other types of industries? What's your experience?
It's hard for me to compare to other industries. How you look at it, I mean, for banking is step one, it's a mature business. There's no great new ideas in banking. That I'm very confident about. It's grown pretty much in line with the economy for now a couple of decades. So, people have always known where they can put their money and where they can get money from. So the top line growth is pretty easy. It's basically analyzing them is analyzing their risks, interest rate risk, credit risk, and leverage risks. So those are challenges. They take, a fair amount of work, but at least I'm comfortable with doing that.
Do you think retail investors tend to overlook certain key performance indicators when they look at banks, or what are the problems you see with retail investors discussing banks?
I would say in general today, I would call it the Amazon problem. People have fallen in love with revenue growth. And that's even in what we call the mainstream media, that's become the dominant theme. How fast do they grow revenues? And sort of ignore the risks of growing those revenues. And I would say valuation. Too many people will pay anything for perceived growth and will overlook, more steady stocks with very low valuations.
So what if I told you that I saw on financial Twitter the comparative analysis between certain banks that aren't yet very profitable within other fintechs, and the metric used, favored in this case, was price to sales? Would you be surprised?
Extremely surprised and disappointed, I'd say.
Yeah. So I completely harping on that point that people are paying more attention for price of sales. I see that also sometimes people blanketly use, price to book. I mean, in my view, how I like to tend to look at it is, Citigroup trades at a huge discount price to book, and we look at it and say, okay, well, price to book, it therefore buy, because I look at JP Morgan Chase and the price to book, it's trading above book, but that
Right.
misses on the context, right, of return on tangible equity, return on equity, et cetera.
Yeah.
Do you view that retail investors they may not appreciate some of the complexity that goes into analyzing banks, which, in my opinion, just as the audience, I view it as very complex entities, more than most businesses?
Yeah. I'd say a lot of businesses have a lot of tough issues. So I wouldn't necessarily say banks are automatically more difficult, but yeah, I think they miss the understanding of those risks. I mean, the easiest thing in the world is to grow my loans. If I gave you $1 million today and said, see if you can go lend $1 million, I bet it would take you about 4 minutes. People are very happy to borrow your money. The hard part is getting that $1 million back. And so to focus on revenue growth or loan growth is, to me, literally crazy. It's way too easy to lend money. The hard part is to lend money to the right people at the right price with the right protections, et cetera.
Would you agree with the overall theme that banks are going to be primarily focused on that their capital is returned to them? They're going to be focused on credit risk, not necessarily caring too much about the interest rate that they achieve on those?
Well, making a loan is somewhat of a complex process, but yeah, you've got to certainly charge an appropriate interest rate, one that's going to work for you and the customer. So yeah, it's all part of the same thing. It's identifying what the risk you're taking and then pricing that risk correctly.
Okay, yeah. And I mean, that kind of gets into I think one of the more hotly debated and contested discussions today on the internet, on YouTube, for retail investors. And that's a bank that our audience is pretty familiar with because we've discussed it in the past. And that's SoFi stock.
Right.
Depending on who you ask, it's the next Amazon of banking, or
Right.
it's a glorified personal loans, student loans business.
Mm-hmm.
So how do you understand the current bull thesis? Like, how do you interpret it?
Yeah, I'd say what I see is the two reasons to buy are: one, they're growing fast, and two, that the CEO puts out targets that he can beat. So it's basically faith in the CEO and confidence in growth, top line growth.
And
So I've heard you. I'm sorry.
No, you go.
So I've heard you say on other streams that you put no faith into what management guides at all. Right?
It's a complicated world out there. You and I have trouble figuring out what's going to happen 2 years from now. Why does this person know a lot more than you or me?
Mm-hmm.
I mean, the CEO has some control, obviously, within their company, but we'll make it specific to banking. The CEO has no control over where interest rates are going, where the unemployment rate's going, or what competition is doing. I mean, there's loads of unknowns out there. To have a degree of confidence that the CEO can see clearly 5 years from now, to me, is dangerous. Any CEO. I'm not identifying the SoFi CEO specifically. Any CEO.
Would you say banking in particular for guidance is problematic more than, say, like an industrial company, or would you put them on par with each other?
It could be. I mean, depends on the industrial product you're making. I can imagine some are pretty steady, others are confusing. But one anecdote I had from many years ago, I was for a little while I was what's called a strategist at UBS. So it was my job to say where the whole market's going. And so I worked with a lot of the individual analysts. One guy was covering cardboard makers. 15 years in a row, cardboard manufacturing went up with industrial production. Okay, I can figure this out. If I know where industrial production is, I know 3 years later, the two lines diverged. Something else happened. You know, even the most boring business things happen. But so yeah, you've got to be take a major grain of salt any CEO's forecasts, especially a couple of years away.
Okay.
And then kind of expanding on SoFi in particular, what the CEO is discussing, I guess what they're mainly known for right now is the personal loans business.
Right.
How do you feel about that product class in banking on a high level?
Clearly, as a first step, it's first thought, it's obviously a risky product. This is an unsecured loan. So, why is this person taking out an unsecured loan at a high interest rate, 12, 15% interest rate? It's, a alternative to a credit card loan. You've got major players in the credit card business with tremendous resources, Capital One, Citibank, Chase, et cetera. Actually, et cetera, American Express, there's not a lot of choices. So you're looking at a small group of very big companies with tremendous resources. So I've got to make a risky loan trying to take business from tough competitors. And again, a very slow growth business. Consumer credit is a slow growth, couple of percent a point year growth business. So it's a challenge, no question.
And I don't know if you've actually addressed this point before, but when I usually hear the argument that I usually hear it from SoFi bulls in particular, that they target people with really good credit scores. And okay, I view that as somewhat, not somewhat, as very credible when you're talking about a loan book of mortgages, even like credit cards. But when someone is dealing with a personal loan, typically that indicates that maybe something has occurred. And while the credit score, okay, as a KPI or metric, it's like, okay, that tells me that in the past they've done really well and they have a high credit score, but something has occurred in their life that they are now taking a personal loan. Circumstances happen, but how do you feel about that argument that usually is laid out?
Yeah, well, I would say the opportunity there is we can imagine at a certain stage in our lives where we feel comfortable about our growth in our career and our growth in our income, but our life events are a little ahead of us. We get a new apartment, we get a family, something. So there could be points in our life where we're pretty confident we can pay back. We paid our bills in the past, but we're just short on cash now. And those events do occur. I mean, that's typically a credit card opportunity. But, those are, that's a small opportunity and has got to be done fairly carefully. And again, is not a new concept. So
Yeah.
there's a valid product if analyzed right and managed right, but it's not a long-term growth product. And it's not a huge market.
I was gonna say the first thing that I saw, like it was like a year ago when I first heard about SoFi, which I was looking at Goldman Sachs as an investment at the same time. So I kind of compared like Marcus to SoFi, and I kind of I could see the disconnect, I guess, in what Anthony Noto was saying, and then what the financials of SoFi showed me. So I listen to management. I don't. But I compare what they're saying to like the production on the financials, and it was not what he was telling me as an investor potential. It just wasn't there.
Right.
Like you were saying, like the growth he's telling is on like the growth stories he's promising just don't seem to be materializing. the risks, the charge-offs, the credit loss allowances were growing at the time, and they were much higher than Goldman Sachs when I looked at them. I don't know, like, what was the first warning bell that you saw with it, I guess?
Well, to me, I saw two things. One was the fast growth, exactly the two reasons that, let's say, the average retail investor, from my understanding, is looking at the stock with the two warning signs to me. One was the very fast growth, and the other was this confidence that management was at least portraying that they had some magical secret sauce that was going to keep them growing forever and make them a dominant player. Again, to do that in a mature business with loads of competitors is nearly impossible. And so I would give myself credit for maybe 35 years in this business. And I saw plenty of growth stories in consumer finance, and without exaggeration, 80-90% of them went bankrupt.
Yeah, that was another thing we wanted to add. Yeah, exactly. Like that point exactly. Like you've seen this rhyme before.
Plenty of times. We had subprime mortgage lending. Had a couple of iterations. They're all gone. Literally every one of them is gone. There was a subprime auto lending business. There were, higher. I remember one was a company that would lend mortgages above 100%, but only to good credits. Had a business.
So what type of stories of these fast growing banks told, like, what have you heard in the past that never, like, what was their shtick, I guess?
Pretty much the same story. We figured out something special. Here's a fun story. This even includes Amazon in there. Late 90s, it's a company called Next Card, started a credit card company. This is ancient history for you guys and probably most of your listeners. But this was just as the internet was developing. And Next Card said that they were doing all their marketing for their credit card online. And they were growing like crazy. So at the time I was following who did I ask? Capital One and another company. Have you tried online marketing? And they said, yes, we have. And we found that for the same exact credit score, losses from our online clients were 4 times larger than through the mail. So basically more desperate consumers, something bad had just happened to them, were applying. But these guys were adamant, and they were growing like crazy, and they had all their special earnings metrics that no one else was using. Amazon bought, there was news. I shorted the stock personally. Amazon then came out and said, we just bought 10% of the company. The stock doubled. I shorted more, and 2 years later it was bankrupt. Yeah, you got the headline, right?
Yeah. Look at the year, everyone. 2002.
Yeah, extremely confident that they had figured it out. Other guys don't get it.
So it's like when technology meets people, it doesn't go
Yes.
very well a lot of times, right?
A lot of times.
Yeah. And that's, I mean, trying to be devil's advocate here. Okay, so we're looking at a bank that's growing a lot, et cetera, but maybe you're looking at it the wrong way. Maybe you need to give it a little bit more credit for it, which, funny enough, inside the Capital Mindset Club, there are people who have work experience in this field, and they had a lot to say about that. I wanted to share that with you, as far as like things that I've learned, because I'm not a customer. I don't use their products, but from my understanding is, we all know, at least from the high level, that once a bank adopts a technology platform, it's almost impossible for them to want to get rid of it because of the risk of the change. So that's the benefit. People who work at firms that use their tech products, actually, they say that their number one handicap, you could say, is actually that tech platform, but they can't get off of it. So it's like a catch-22 there. And I also view the proposition for, and this is kind of like, again, kind of taking a step back, high level thinking here, that when you are competing. Let's say you have a bank, I have a bank, and I have a technology platform, and then Dan has a technology platform, but he's not a bank. The analogy I usually give is I'm trying to give you a reason to use my tech platform, but we also compete. Dan doesn't compete with you. So my value proposition is I have to be that much better than Dan, in my opinion, where you're going to say, okay, I'm going to go ahead and establish my business on your platform. Do you think that potentially is a blockage they might experience going forward?
It could be. Honestly, I don't know. I've never sort of dealt with that process or followed companies that dealt with that process. So I'd consider myself definitely an amateur in this discussion. And I would say if there's going to be sort of a big positive surprise that I'd miss on SoFi, it would be their tech platform. But I would say higher level, I feel a little more comfortable. Have they figured out some sort of platform that is dazzlingly better than the competitors and that will remain so? It seems hard to imagine that, this is going to be a big monster product, especially as I imagine in this growing AI world where I think developing new software is going to get faster and faster, easier and easier, cheaper and cheaper. For anybody to maintain a competitive advantage is going to be tougher. So that would be my concern. And again, we're going to have to see, when I say I'm a value investor, I'm also sort of a longer term investor. So, what it does next quarter, I'm not that worried about, but we'll see over the next few years if they really figured out something super clever in that business.
No,
maybe.
So some of the proponents of this company are betting on, well, one of two things. Either it's going to be $100 billion like Jamie Dimon, or it's going to get a valuation as a tech company instead of a bank. If you put your analyst hat on, would you think you'd ever want to value a chartered bank as a tech company? Is there any situation you think you would do that?
Unless a substantial portion of their earnings came out of that tech platform, and not only that it came out of the tech platform, but there's, I'm sure, plenty of tech platforms. IBM is a tech platform. What's its multiple? 10. There's plenty of more mature tech products where you don't get the magical tech multiple. Tech multiple is a tech multiple because it's a growing area of the economy. So they would need two things, that to be their dominant product and to be really good at it.
I want to highlight something you just said, though. You said earnings. Why not revenue? Why would you not use revenue as your metric for the pie?
I've got a restaurant I'm going to sell you. It's got $1 million in revenues. I think we can grow revenues 20% a year. It's never going to make you money, but it's going to grow your revenues. How much are you going to pay for my restaurant? Some number close to zero comes to mind.
Can I issue convertible notes on the asset? Because I might think about it.
Yes, if I could do some creative financing, but we buy our investments, and an investment is part ownership in a company.
Yep.
Nobody starts a company looking for revenues; they look for profits. So ultimately, that's the payoff. And I would even suggest the CEO of SoFi would ultimately agree with that. His definition may be, well, our profits, if we keep growing revenues, our profits can be out there in the distance. And that's the Amazon argument. Amazon has managed to, dominate two businesses. That's a rarity. And imagining that in financial services is nearly impossible.
Well, Gary, let me just tell you, the premise is wrong, because as soon as it's publicly traded, then that mentality just changes for me. I don't view it as a business I own anymore, just a ticker I can sell.
That helps keep me grounded, is I'm buying a share in a business.
No, most definitely. And I think that even amongst the people with tons of years of experience, they often tend to forget that. It's one of the basics. And sometimes, hey, we forget the basics.
It's funny. Before Amazon, that never would have been a consideration. I'd never heard that in my career.
That the profits will come later.
Was about making money.
Yep.
The concept of growing for decades without making money was incomprehensible. This is a newer concept.
Yeah. That, and kind of like a survivorship bias there being applied. It's like, oh, it worked for this one, therefore it's going to work for all of them.
Yes, you didn't see the literally thousands or tens of thousands or hundreds of thousands that failed at that process.
Yeah, precisely. And then, so what, I guess this is the overarching question here, isn't it? Why is it such a popular company?
I would honestly think a lot of it is management hype.
Oh,
they're telling you. I mean, I'll read from their transcript. They did first quarter earnings transcript. Q1 was another exceptionally strong quarter for SoFi. We continue to successfully execute on our strategy of making SoFi the one-stop shop for digital financial services. And let me read that again with a different emphasis. The one-stop shop for digital financial services. So they're telling you they're doing exceptionally well and they're going to dominate the industry.
Okay. They said one thing in there I wanted to get to. I'm pretty sure I know what you're going to say, but what do you think about all, like, them and other banks talking about building an ecosystem? Right. Robinhood's doing the same thing kind of at this point.
Right.
This concept.
Well, 48 guys are building an ecosystem. Read Rocket Mortgage's stuff. They're building an ecosystem. Everybody's building an ecosystem. I follow more real estate oriented. Zillow, Redfin, they're all building ecosystems that are dazzling. Is that how we operate?
No.
I decide, well, I got this one bank and that's my bank and I give them all my business. I couldn't possibly switch. No, I mean, I heard that years ago, the ecosystem guy was Wells Fargo. I mean, they had a statistic, a number of products per customer, and they would constantly promote it and work at it, as their business. They ended up making up products to, because their management was pressuring the employees to add products, got in huge trouble, and it never occurred. Where their consumers have loads of choices, the switching costs are not that great. It's at the minimum extraordinarily difficult. And until I hear somebody say we're uniquely gonna have an ecosystem because of these magical things that no one else has thought of, I think it's laughable.
So would you say Americans are typically able to navigate financial institutions and have 3 or 4 banks and they pick the best deals and they have no problems dealing with multiple institutions?
Is your bank account where you have your credit card, where you took out your mortgage, where you've got your auto loan, where you buy your insurance, where your brokerage account is?
No.
I mean,
I work through like
a large percentage of us, not only do we have maybe one different one for each one of those, but we may have multiple ones for the same product. I've got multiple brokerage accounts. I've got a couple of bank accounts. I've got 3 credit cards. 6 credit cards or so. Where's my ecosystem? Who's got my ecosystem? And the world's switching is getting easier and easier. One thing I think is, I'm sorry, go ahead.
No, I just wanted to add in, it's almost like you're highlighting again and again and again that it's a commoditized product.
Yes, it is. I honestly think I feel comfortable saying my 35 years in the business, I've never seen a new product. Or it's very close to that. There's little wrinkles here, but a loan is a loan. Underwriting is underwriting. I mean, there's little wrinkles here and there, but all the imaginative new products, I mean, not all, but the great bulk of them have been proven wrong.
So if Dan offers you a loan, same exact amount approval for 9%, but I offer it to you for 7%, you'll just choose me, right?
You're my man.
What if I support the army?
Yeah.
Just throw that in there.
There we go.
What would you argue as, within the context of SoFi, what is their greatest strength in your opinion, and simultaneously, what do you think their greatest weakness is from the business standpoint?
As a strength as a business?
Yes, as a business.
That's a good question. I mean, deposits, I don't see anything as a strength there. Maybe they're a good marketer. I would say their personal lending business doesn't look like a disaster. It could be a real business, although it's not some magical powerhouse. So I would say there's areas of competency.
Okay, because again, usually the bull argument would be, well, they control their own tech stack, so that's their strength.
They control their tech staff.
Stack. So like they have Galileo, they have Technesis that are products that they use themselves, and then they offer that out to other bank-like institutions. Like Robinhood's a customer, Chime's a customer.
Well, again, for their tech business, I say I'm an amateur, so I can't judge how good they are at that business. Does that give them an operating advantage in the banking business? I'd be, as a going after consumers, I'd be surprised, unless this tech stack was far superior to the tech stacks that a Capital One or a JP Morgan can have access to. I would find that hard to believe. Those two companies, their tech budgets have got to be far greater than the revenues of SoFi.
And from people who work in the field, the answer, or kind of adding to your comment, is the answer is no. It's not superior.
Okay, then that makes it more clear, right?
Yes.
Okay, that's interesting to hear.
Yeah, and it's something that, again, I find a bit fascinating, because that's one of like the things that people hang the thesis on.
Right.
One of the things they often talk about membership growth as being the number one KPI. I found that very interesting. You said that you don't view that as a strength. Why is that? Why are deposits not necessarily a strength for a bank?
Well, what's the cost of those deposits? I just looked again recently. Let's offer 4.6% and $300 for doing payroll deductions, direct deposit. I mean, that's very much at the high end of the range. So to say they're good at growing deposits, of course you are if you're paying more than your competitors. The hard part is, as I said, just like lending, it's easy to give money out. It's hard to collect it. It's easy to collect deposits with a high interest rate. It's hard to make money off of that. And from the work that I've done, it looks like at the moment it's a substantial money loser.
Yeah, so it's a liability, and not an asset.
So they're paying, let's say with the bonuses, they're paying close to 5%. Let's round off to 5%. To reinvest that in a security, they're going to earn about 5%. In loan after credit cost deductions, could they earn 7-8%? Possibly, but then now they've got overhead to cover. Banks, a bank branch system runs about 1.25%, 1.5%. They don't have the branch system, so their cost should be lower. The reported expenses they report in that business are 2%. And that excludes a substantial amount of unallocated expenses that clearly some of them must go to this business. So they're probably paying 3% plus. So they're paying 5%, they're paying 3% for their overhead. There's no way that they make money as a business. So that model doesn't work. In my opinion, so far, that doesn't work.
Okay, so that's a really interesting point that I want to spend a little bit more time on. So just so I understand, you're saying that the argument usually put it out is that they should be more efficient because they don't have branches. Like they don't have those costs. But you're saying that even though they don't have any branches, it doesn't appear as though they're experiencing a significant spread from that cost savings.
I don't see it. Again, they report 3 segments and the profits in 3 segments. Magically, those 3 segments all make money, yet the company is overall, barely was above break even. Why? What explains that? They've got substantial amount of costs. This is doing on an annual basis, something like $1 billion of costs that they didn't allocate to any of their 3 businesses. It's about 40% of their expenses.
I noticed that about, we noticed that part in their 10K.
So
and it's going down. The percentage reportable from 22 to 23 went down as a percentage of expenses.
Really? Wow. So yeah, I've seen companies do these breakouts between their businesses, but the unallocated expenses are typically something like 10%. You've got your headquarters functions of
executive
accounting, tax. There's some, how 40% is inexplicable. So if I reallocate some of those expenses to the various businesses, then the banking is a significant money loser.
And now you're not arguing fraud. Let's be clear. You're just arguing just changes in how, we are showing certain things.
I would say that as an outside investor, it's very difficult to get the information that I would want to use to analyze the company.
Yeah. And those are exactly the kind of companies you'd like to invest in, the ones that make it difficult for you to tell what's going on.
I mean, if I had access to the company, which actually I did email them at one point and say, gee, I've written about you, et cetera. Would you want to talk? And didn't hear anything back. But yeah, if I could talk to them as an investor and say, okay, these are my questions, and they gave me reasonable answers, okay, I could buy that. But, without them giving me, clear guidance, and without them trying to explain things to me, it's uninvestable for me. And obviously raises concerns about why don't they allocate these extra expenses? Why is it so difficult to find out their loss ratios?
The same person who told me about the tech stack gave me a bit of commentary as far as like sometimes reporting for these businesses, as far as like creating presentations and stuff, that it's not abnormal, obviously, to summary, long story short, before telling the whole story, or not telling the whole story. He could tell that some of the performance measures that they were showing were, as he said, BS, meant to look better, but hide perhaps what's going on. That was his opinion. He agrees with you, which is funny you're saying that here.
Yeah. So like when they do the presentation, they show number 1 members.
Yep.
Then they show products, which includes one person could count for like 12 products, the way I read the notes. Then they show Galileo, which that account number includes interagency accounts. What do you think of, that's what they're showing right in the presentation? So that's what they want you to pay attention to as an investor. What would you say to that?
I would say this is marketing. So they're going after investors looking for growth, and they're going to put up every number that
any growth number they can find, right?
Any growth number you can find, put the other numbers underneath, make them confusing to understand.
Make the notes
really taking advantage of people who are, looking for a big home run investment, sort of taking advantage of their, I would say at this point, gullibility to focus on the growth and forget how they get there.
Now,
banking, it is so easy to grow. It is so easy to give away money to people. It is so easy to collect deposits from the highest paying company. That's not hard. Growth is easy. Profitable growth is extremely difficult.
Sorry, Dan, you go.
So do you consider rapid growth a red flag or a positive with banks, or are you more interested in what's behind that?
Yes. Honestly, when I got in the business, I'm an old man in this YouTube world. So this was probably in the 1980s. I read an article at that point written in the 1980s saying that fast growth was the leading indicator of future bankruptcy in banks. This is all before the subprime lending waves and the other clever lending waves that reproved that. So yes, everything I've seen in my career says that. It's unfortunately how it works. How do I take, if I've got slow growing business with big competitors, how do I get business from them? How do I generate fast growth? I've got to typically be easier on my lending or overpay. I've got to give up credit quality or price. The third alternative of being far more clever than all these other competitors is possible, but very slim.
And another thing that I learned by talking to people who work in SoFi competitors or just the fintech space as a whole is that typically the strategy for most fintechs, which SoFi didn't do, it's not necessarily a bad or a good thing. It's just pointing this out, that you usually go after lower income cohorts first, because that's the ones that the big boys don't want to play with.
Right.
So the reasons is like, you go to, let's take Bank of America and JP Morgan. They have minimum deposits. They have minimum requirements before you stop getting fees. And they don't find those customers profitable. Makes sense. So then if you're a fintech starting out, you say, okay, what realm can I play in to get customers now, and then worry about developing later on. One of the bull cases typically argued, kind of getting back to that credit score topic, is, well, SoFi did it differently. They went for the what are they called? Henrys? Are they Henrys? It's not yet rich people, not yet rich, but high income earners. High income earners, not yet rich.
Okay.
And so that's a huge point, because I find that conversation a little bit difficult, because I look at SoFi's products and I don't really even see anything that's attractive for a high income earner, let alone high net worth, because that they say they don't target people with high net worth, but there's nothing in there really that, like, let's take Bank of America's consumer banking. They have the reward system that the more you have with them, you get more perks.
Right.
And a bunch of banks copy this. Chase has one too. And there are even products at some banks, if you're a high income earner and you have large deposits going through the bank, they'll even offer you perks. So do you think that the strategy, let's say, of going after the Henrys, is that really something that we can say is a benefit to SoFi, or is
I
that
could
kind of
say, is there a little business in there? There could be, but yeah, again, if I'm this high income, not yet rich, the product that they're offering me is an unsecured consumer loan at 12 to 15%. Once I get to be rich, how much of that loan do I want? I'm rich, but I'm still borrowing at 15%.
Yeah.
That's not one of the products you're looking for. Because you got that loan from them 10 years ago, now are you moving over your brokerage account to them? Are you taking their mortgage? Maybe, but highly unlikely. I don't think that's a way to get a customer for life. That's maybe a short-term opportunity. That person is looking for to cover a very specific event. They actually, just reading their earnings transcript, they're saying they expect this product to last maybe a year and a half, and it's not even lasting that long.
Wait, say that one more time.
The personal loan has an expected life of about a year and a half, but it's actually paying off faster than that.
So they're not getting the full.
So how does this establish a long-term customer relationship and create this ecosystem is beyond me.
Do you think they're refinancing, or do you think they're paying it back right away? Or
I honestly don't know. I would be a little, well, it's possible you could refinance into maybe a home equity loan if they happen to be a homeowner, but I'd imagine they're paying it down.
All right.
I mean, if you're a good borrower with good income, one of the first priorities of your excess cash is to pay down a 15% loan, I would think.
I mean, like once you have assets, like I have access to home equity lines of credit that are I have one right now locked in at 5%.
Yeah.
Just sitting there, right?
Exactly.
So
what am I doing?
I have no use for personal loan. So
right. This is embarrassing, but there's a competitor company that makes unsecured loans. Another fintech. Slipping my mind, but I was doing a little sorry?
Upstart?
Yes, exactly. Sorry. Upstart. So
I had like 3 guesses. So.
Upstart has a similar product, maybe identical product. So I applied for an Upstart loan just as part of my research. So they said, how much do you want? I said, 15,000. What do you want it for? I said, home improvement. And then they collect this data on me, and they pitch like Sofi. They pitch their technological prowess. You cannot read a sentence with them without AI popping up. So they know presumably a lot about me. What they should know is that in my neighborhood, nobody borrows 15,000 for home equity project, for a home improvement project. And if they did, all of them have substantial home equity that they can borrow against. So if I took that loan out, there's only bad news for them. I'm getting a divorce. I got gambling problem. There's something that allowed me to turn to them. And that was honestly the company that I was mentioned before, that the high loan to value ratio, high credit score company, that's what they ran into. All the people who were, they didn't know, but their credit was turning significantly negative. Those became their customers. So, is there a little niche in here? Yes, but is this a business to build a big customer base on? Absolutely not. Is it a big opportunity that's going to keep growing? Absolutely not. And there's competitors. American Express has offered me a personal loan. Discover offers personal loans, all in competition with credit card debt, which is another alternative for an unsecured loan. So, could they be doing an okay job in it? Yes. Could that be, their path to glory? Absolutely not.
Yeah, they would have to have some sort of secret sauce that you're kind of, you were talking about earlier, and it's just not clearly visible.
Well, if Upstart with all its technology couldn't figure out my circumstance, I wonder, how much they know.
And of course, right, we're not even getting into the gray rhino over here to the side, that should a downturn in the economy occur,
sure,
do you really want to be holding a portfolio?
That's the test for any unsecured lender. Yeah.
Which we haven't seen yet.
As good as Capital One's a wonderful company, they took a serious beating in the 07-08 recession for that question.
Yeah, the charge-offs for SoFi went from 1.8 in 22 to 3.4 in 23.
Right.
And economy's doing great. I mean,
the unemployment rate is near the lowest ever. Yeah. So yes. And things could happen. Not that I'm the one you'd want to turn to as expert on this, but thinking about AI, AI to me looks like a white collar job killer. We're going to have computer programs replacing a lot of the work that we're doing. That 750 FICO score customer, once they lose their job, they're not 750 FICO anymore. So, so we haven't, not that I'm not saying they're terrible at the business. I'm saying it's a smaller business, and it's subject to economic changes that even, SoFi's CEO can't necessarily forecast.
And we're getting into, right, what you said about the losing a job. The difference, obviously, with a auto loan or a home loan is there's something that you take.
Yes.
Right. So you stop paying your mortgage. I'm the bank. I lent you money. Well, there's a house that's collateralized. And you stop paying your car payment. Same question there. Personal loan, what do I get from you? I ruin your credit.
Yeah. It's like having a restaurant. Once the restaurant meal is over, they can't take, they can't get it back. Yeah. Once they've given you the money, you're not giving back, and you couldn't care less. Is it going to hurt your credit score? Yes, but it beats losing my car or losing my house.
Yeah. And we had this comment from Andrew over here. Andrew's he does reporting for his own business, and so he's more or less familiar with structuring. He found this interesting, and I think he's talking about this, which I'll go ahead and share. The way we read this isn't it kind of weird that CC, credit cards, is kind of categorized? I don't know if we're thinking of it wrong, but it's categorized with the other products above, and it's not down with the loan. So the question he's asking you is, are credit cards a loan or non-loan account?
Yeah, it is. I agree with you. It's pretty funny. For some reason, the credit card business is in the deposit business rather than the personal loan business. And
it's very strange.
It's far more closer to a personal loan than a consumer deposit.
Yeah, because you were using that as a comparative. That's who they're trying to take business from at the end of the day.
I would say in most cases, your natural alternative if you're looking for unsecured credit is a credit card. Why would I take a personal loan? I mean, I guarantee every one of their 750 FICO credit card customers have credit cards. Why would they take a personal loan? Probably only to lower, a 19% interest rate to a 14% rate
And
for a
I
short
mean,
period of time.
one thing that I find weird too, on top of that, because even as a consumer, I mean, I got a credit card recently, a new one, and from Bank of America, and they offered me 18-month, no interest, and they gave me a pretty substantial credit limit,
Super.
more than about what I would get from a personal loan. Why would I use the personal loan?
Right.
Maybe something's wrong with me at that time, and maybe Bank of America sees that in their end and doesn't offer me a credit card. Now I have to go for a product that's going to charge me 15 or some odd percent.
Well,
Right.
you get
I
like,
mean, if credit cards really, I haven't seen that much, that length of a teaser rate, but yeah, take all you can on that and pop it in the bank for.
Actually, I think it was 15 months, not 18 months, but yes, it's
Okay,
more than a
still.
year. Yeah.
I have like 8 credit cards. Someone's always offering 0%. I could
Really?
probably just punt a friggin' balance around and never pay
Yeah.
interest.
Right. Yeah. Then that in the old days, that was much more common. They sort of stopped that because it's so stupid. But that, I mean, honestly suggests to me that the competition is getting pretty fierce.
I mean, you pay like 2% and they give you free money for 18 months.
That's
something
crazy.
Like
that. Yeah.
I saw that stop last year.
So
though.
think about that. I mean, it's an excellent point. If this is really happening, and this is honestly news to me, then that's wicked competition to SoFi.
Here, let me see if I can actually pull
And
this
meanwhile,
up.
they say, I mean, another quote I popped out of their transcript was that the credit card business has huge ROEs and that they're going to be, big players in this. And you're saying the other players already are offering teaser rates that are huge money losers.
Mm-hmm.
You're getting more.
What do you think of I know you haven't covered Robinhood, I don't think. I saw.
No.
It's not a bank, obviously, but
Yeah.
what do you think of like the overall concept? Because it appears they're trying to create this like monthly membership gold club with like these higher perk benefits than their competitors. Have you ever seen that before?
I guess I've seen it it seems like a similar, ecosystem business strategy.
Yeah.
I think they've proven that, having these low net worth customers doing trading is not a profitable business. So I think they're looking to try to get I would call the more traditional, maybe not necessarily the JP Morgan customer, or the Morgan Stanley customer, maybe the Schwab customer. So they're looking for, stickier investors to earn annual fees on. So it's a challenge, but again, they've got big competition out there. I'd be a little.
And nobody really does that. Do you know, like because they're charging $5 a month, I think, for now. But
so
kind of a unique idea I've seen.
Yeah, I honestly don't know. I mean, I have to take a look at it. Sounds interesting. It does look like a company that would be fun analyzing.
It was okay.
I pulled this up. This is Chase for anyone's watching. This is for their no annual fee cashback card. I think it's the Freedom Unlimited, and all of them are offering. They all have the same introductory APR, 0% APR for 15 months.
Wow, $200 bonus cash back.
Yeah.
Wow.
Yeah, and depending on your relationship with them, if you're a high income earner, and depending on your relation with them, they're going to offer you, I don't know, 15, 20,000 limit. I mean, for the Bank of America one, I got another red one. That one they gave me 30.
Right.
Yeah. I know that Capital One, this is unspoken rules, but Capital One, they have a limit on how much. I think most of them do, but they have an unspoken limit on how much total credit they'll give you. So sometimes when you ask for a raise on one, they're like, "Oh no, we won't extend any more to you," because cumulative is like 70.
Yeah, I mean they're smart companies, but I mean obviously this product is a money loser for some significant amount of time certainly for that 15 months. So you've really got to hope that they've got a customer retention strategy that keeps that customer for a number of years after that to make this work.
Yeah.
So again, if I look at this, if I was a SoFi investor, I would be a little nervous about looking at this ad and thinking my company can compete with offers like that.
Because on top of that, yeah, 0%. And I mean, presumably the spend that I'm going to be doing here, I'm also going to get a return 1.5% cash back. I'm going to
Right.
get my small little bonus. If you're doing a big
Yeah.
purchase, like, I don't know, $15,000 purchase, okay, the bonus offer is not that big of a deal, 200 out of 15,000, but 200 bucks. SoFi is not going to give you $200.
Well, they do. They give if you move to direct deposit, they'll give you up to 300, they say. Which makes me a little questionable about the idea of direct deposit. Is the goal of it presumably is to create a sticky customer. But how long did it take me to move my direct deposit from whatever bank it was to SoFi? 5 minutes.
Yeah.
Once faster. The bonus is over, and if SoFi says the only way SoFi is ever going to make money on me is if they lower their money market interest rate from 4.5 to, let's say in today's environment, 3.
Yeah.
Am I going to automatically stick because I don't want to spend another 5 minutes switching to another bank? Or so
I think people go out of their way to save anything. Like,
yeah, and if it's
sort
that
of
easy,
0.1%, people will go that far.
Yeah, and I keep harping on AI, but if I got my little AI financial advisor 2 years from now who's constantly combing the internet and says, you've got your account at SoFi, but if we move to Chase, you get X, Y, and Z, and you're better off. Hit this button. The concept of sticky customers, I think, is going to get tougher and tougher. So even Chase, I'd be worried about here. What are they? Be interesting. I would say at the minimum would be interesting to know what they are thinking when they make this offer. Maybe we shouldn't draw a conclusion up front, but it's worth a pretty big question.
No, they all pulled this offer. All these offers weren't here in 2023. I can tell you that.
Wow.
So these came back at some point. Frankly, I might not have been paying attention exactly to when exactly they came back, but I recall Q1, Q2 of 2023. I was looking for a travel card, and I was shopping around and just was noticing that the 0 APR offers were gone temporarily because they're back now.
Right.
So
that's honestly, you're making me more nervous about SoFi and making me. I mean, I don't own Capital One or any other credit card company, but I'd take a harder look at taking the short side of them.
Really? Okay.
This sounds bad. I mean, from the look of it, maybe they're banking on the customer not maintaining a balance, that the cash back is enough for them, and they're not going to. But if they maintain any borrowing, the companies, you're losing money in Chase.
Yeah. I pulled up our European members' comment because in the EU, this is kind of still unheard of. Getting 1.5% cash back is a lot. Yes.
I use my American Express on everything, and it's like 1, 2, 3% cash back, depending on the item. I mean, it's quite a bit of money, actually.
Yeah.
And then some people are like, oh, rich people don't care about that stuff. I'm like, everyone cares about it. Why would you not take 3% cash back if you could get it? Like, I don't understand.
Yep.
That actually brings us into a little side quest for us on a particular bank, not bank, but bank product, Robinhood's credit card. I mean, typically when we look at credit cards, we know that 3%. Would you say that that's a tough cashback offer to make very profitable?
Yeah. When I was covering credit card companies, which again hasn't been now, and I haven't done that in 15 years, 2% was not profitable. 3%, I don't know how the economics have changed. It's possible. Merchants, I think especially smaller merchants, get pretty screwed by the credit card companies, so their fees to these companies are huge. So I would think there's probably been some increase in the amount they're taking from merchants, which maybe makes them make the cashbacks a little more they can be more aggressive on. But 3 sounds tough, especially if you're Robinhood without scale, without, real deep knowledge of the credit underwriting. It's got to be, it sounds like they're trying to be, create loss leaders to get a different type of customer, which is a tough bet.
Almost like saying, get you into the, what's it called? The ecosystem.
Yes, 100%. Over and over, this keeps popping up. All of these magical ecosystems.
Because just for context for the audience, right? You have back in the day and that's not that back in the day, but the Citi Double Cash as a product was pretty novel at the time when it came out. 2% on everything. And they kind of set this like newer standard that some people start copying, but you still see like Chase. Chase's standard is 1.5. They have the 1.5 catch-all card. Interesting that you say that, Gary, about the 2%. You remember it not being profitable. And I know that Bank of America they have a 1%, 2%, 3% for the red card. The 3% and the 2%, they cap those. It's not, but the reason why I brought up Citi is known for being more of I wouldn't be so strong to say subprime lender, right, for credit cards, but they typically target people, right, that carry a balance. And if you look at the charge-off rates, they tend to be higher than the book of a Chase. Chase is almost on par with American Express. They're usually the ones that are looked at the same. So it's very interesting to say that. And I think, by the way, the answer to that question of what they charge merchants, I believe it's like 4.5% now.
It depends on the merchant. If you're Walmart, you're probably paying under 2. But I go to some local merchants where I now pay cash because they tell me they're paying 7-8% to merchant fees.
Oh my God.
Oh, it's horrifying. It actually infuriates me. American Express has all these ads, support your small business. Meanwhile, and they're just raping them.
Well, that's why I carry a MasterCard, a Visa, and American Express, because you never know. Well, yeah, American Express, sometimes they just won't take it. So
yeah,
if you're a small guy, it's murderous.
Oh yeah. This for June's comment. Yes, now the 2%'s become a lot more prolific. A lot of places. SoFi is 2%. So it's much more common.
Yeah.
So
I'd say that's a warning sign for the whole business.
Warning sign for the whole business. Oh, that's good to know. So you said there were 2 instances where we wanted to ask you about an article you wrote that you quoted or cited the 10K. And one of them, the first one that I'll ask, is on page 107 of the 10K. You discussed the issue that a lot of our members also found quite interesting. There was a Financial Times article on this topic, and it was the fair value method for loans. Can you help the audience understand a little bit, like why is that a problem?
So there's 2 ways I can account for a loan origination. One is a simple cash method. So I make the loan on day 1, I earn interest income over time, and take my losses over time, etc. So that's on a cash basis. Companies are allowed to use what's called an accrual method, where you don't follow cash, in which case you can front load the earnings you expect from a loan. This is standard in the mortgage industry. If I look at a mortgage lender actually loses money on originating and selling the loan, but earns money by collecting servicing fees over the time. They're allowed to take those servicing fees they expect in the future, record them all today under complicated formulas, which I won't bore you with the details on. So fair valuation usually means taking some future earnings and some expenses, present value, and recording them today. So you can imagine, one is just the risk for us investors that the company using these complicated formulas is much more optimistic and front loads a lot of income, or circumstances can change. So at the absolute minimum, we'd want to know how they were making these assumptions, how important those, the fair value earnings are to their current earnings. So it's very complex. The history of that is pretty bad. A lot of those growth companies that I talked about, supposed subprime all used this fair valuation lending to investors' distress. So
you don't get a lot of detail on it in the.
You don't get
they
detail.
just tell you what they're doing.
Very difficult to analyze. It's hard to know what how the cash flows match up to these reported earnings. So at the minimum, it requires a lot of questions. So I'm not saying SoFi is doing anything
illegal. It's not
evil
illegal
in here, but I would at least have a lot of questions, and I would clearly prefer that they don't use this method, that they use more of a cash bet method.
I'm trying to, again, be devil's advocate here. So I'm using the fair value method because I'm trying to show the investor base like what the fair value of these loans are, because what if I want to liquidate them? What if I want to sell them? Is there a reason to do that? Is there, we want to pump the brakes on that too?
If they could sell them for those, if they're really saying this fair valuation represents what we consider fair market value that we could get today, this week, and we're in the business of doing this a lot, then yes, it's a useful figure. We also got to keep in mind that could change radically. And back in the subprime days, so companies would originate a subprime loan and could sell it, so let's say $100 loan, they could sell it the next day for 103. And so they were showing profits based on 103. When housing started to falter, losses rose, the 103 became 95. So suddenly making a loan was a loser. Would lose you money. So all of a sudden, this highly profitable company is now not just less profitable, they're going out of business. So, if you're saying, okay, we're in the business of buying and selling, as an investor, you should know this is a highly volatile income stream, and, don't bank on it forever. And we should know what the kind of circumstances are where that income would disappear, like a rise in the unemployment rate. Suddenly it's going to be quite difficult to sell unsecured personal loans.
And there's no long-term agreements, right? Like they'll just stop buying loans, right?
I can't guarantee that, but any buyer, that would be psychotic to say, I'll pay 103 for the next 2 years for any loans you deliver me. It'd be pretty scary.
They're not going to run a charity with them, right? They're not going to bail them out.
So yeah, at the absolute minimum, even if the accounting is good, it's a volatile income stream that we should keep in mind.
And there was another point, Dan, that you had a question for us as far as specifics on the 10K.
Oh, I think we talked about that one earlier. The expenses and the reporting segments.
Yeah. Right.
But what about that marketing, right? That was something that we talked a little bit about off camera.
Right.
We ask Air, like, do you know what the NBA deal cost them?
Right.
And I've been asking this for like a month or two now.
Right. I like to tell my SoFi stories, the articles and the feedback I get from the articles, which are mostly hostile. And every one of my friends I talk to, none of them has ever used a SoFi product, but they all know SoFi because of the marketing. So it's clearly an expensive effort. They've got the naming rights, they've got the constant, a lot of ads, the agreement. Yeah. So it's expensive. Will it pay off? I don't know, but certainly it's increased their profile and probably helped their stock.
I found how much the football stadium cost them. They only mentioned it like once, and it's somewhere in the 20 to 25 million a year.
Wow.
But then they also say it will increase with economic activity because the NFL has bigger plans for that stadium. So like more events, I think will increase their payment.
Wow.
So
that's
like,
a
it's
lot
only
of
mentioned
branches
one
right
place.
there.
Yeah. Like, so imagine with the NBA deal, they have like SoFi on the court during the playoffs.
Right.
I can't even imagine what they're paying for that.
Right. So again, they call it the headquarters complex, but when you get the companies who are trying to be big and flashy, headquarters or marketing, very often bad things are happening. It's more about.
If only there was a crypto company that put their name on a bunch of stadiums recently.
Right. Coinbase is all over the place.
Oh, another one though,
Another one?
where the guy went to prison for fraud.
One that went bankrupt and what was that name,
Slapped his
Dan?
name on everything he could.
Okay. I'm not going there, but I hear you.
Yeah. If anything, devil's advocate, this is one of the most important KPIs for the business, and all that investment is going to lead to massive growth here.
Mm-hmm. Right.
What can be overlooked here with using this as like my primary key point that I judge as success?
I keep saying it's nice that they've got more customers. The key is, what's the profitability of those customers? As we're talking about now, what's the expense of getting those customers? So we've learned very little, I'd say, just looking at this. I would say strongly, anybody can do this. Anybody can do this.
So last year I opened an account, put like a few $100 in it just to get a promotional points deal they had for like $20. And then I took all my money out. So I'm probably a member and I have no money in Sofi, but I bet you they count me because I still get emails for my account being active.
Yeah, that's a side point, but yeah, what's the definition of a member?
Yeah.
Is a good question. So,
yeah. At one point they were offering a very generous credit card bonus offer for the amount of spend you had to do. I believe it was like 300 for, this was like 2021 or 2022, somewhere around there. Really trying to get people on the credit card, and you had to do direct deposit and all that jazz in order to qualify for that extra bonus. But we have, I guess, some questions for you regarding more so about the banking industry, and maybe we can get into mortgages for just a tad bit. But this regional banking crisis we saw in 2023, like what was your view on that? Do you think that we're past that at this point? We're a much healthier place, or are there things that concern you that have kind of rippled through that event?
I would say there was probably a couple of things that were unexpected if we went back 2 years. And I'd say, one that is important is the office vacancy issue. That nobody would have thought pre-COVID that, so many of us would be working from home. I say us, even though I don't work, but so many of you guys wouldn't be working from home. But it's a real thing that's developed. And if I made an office loan 3 years ago in a different environment, I've got an issue. So it's not a huge problem for the banking industry. It's a couple of percent of their overall loan portfolios, but it's going to be painful. And there'll be losses for a couple of years. Nothing threatening a reasonably run bank, but painful.
I believe that addresses
the other thing was some companies, not the industry, but some companies forgetting the messages of the 1980s. Savings banks traditionally would make a fixed rate mortgage loan and finance it with basically short-term deposits. For decades after World War II, interest rates are pretty stable. That worked. 70s, interest rates rose. They were still earning 7% on their mortgage and suddenly had to pay 10% on their deposits. They went bankrupt. Massive amounts of them. We had a bailout, S&L bailout in early 1990s. It cost the country $500 billion, which was enormous at that time. But the regulators told the banks at that point, you've got to manage your interest rate risk differently. And my assumption was it was very obvious and everybody's doing it. I was wrong. Some banks took on material interest rate risk, the ones that went bust. First Republic is one I looked at most closely. It's just shocking what they were doing. Silicon Valley similarly. So
who failed their customers worse between those two? Like which management did the worst, more egregious thing?
They did a big favor to all their customers. Yeah, they were giving out all these low interest rate loans and ultimately went bust over it. They hurt their investors. They didn't hurt any of their customers. There was a big panic about their customers. This was laughable to me that people worried about they're going to lose their uninsured deposits. One, it's literally never happened. I really probably would be willing to go back to World War II. No bank has failed, and uninsured depositors have lost their money since World War II. Why that information never came out in the press is amazing to me. Two, if the federal government ever tried that, clearly there would be a panic in the banking system with a major recession to follow. They're never doing it. It's never happening. What they will do is just force more capital onto the industry, maybe do their job better and regulate a little better. If I looked at First Republic in 2022, it would have taken me 6 minutes to figure out they were making a big mistake. So there were some that mismanaged this. Most, honestly, banks do better with high rising interest rates than they do with falling interest rates typically.
So you're saying they didn't take appropriate steps for the risk of increasing interest rates?
But it wasn't just they missed a little, they missed dramatically.
Okay.
You don't put on, First Republic put on $100 billion of 3% mortgages. They're going to have an extremely long life. Who's ever going to pay those loans off? No. They're going to have a 10, 15-year life, financing it with deposits, which at best move within a year. That's disaster. You don't do that. That's why banks don't hold you. If you take out a fixed rate loan, banks won't keep it. They sell it into the mortgage-backed securities market. They can't do it. It's too much risk. First Republic did it to a huge extent. So I would say regional banking got tainted with, the bad management, the mismanagement of 3-4 banks. Other than that, the other banks are muddling through and will muddle through the office, problem, and we'll see what happens. So it's not a great business right now, but it's certainly not a disaster.
Okay. And I assume, have you been keeping up with the NYCB, New York Community Bank Corp fiasco? How do you feel about that one?
Well, they've got a different problem, one that maybe you know in Albany. I don't know, but they're a big lender to NYCB. Historically, their primary loan was a loan to apartment owners in New York City area, New York City, Long Island.
Yeah, I was reading about that. Yep.
Right. And those guys have two serious problems. One problem is a lot of these are rent controlled, which means that the state sets the amount that you're allowed to raise rents by. In the last 3 years, there's new regulations. They probably average 1% a year in allowable rent increases. And there's other parts of this make it even worse. I won't bore you with. Imagine getting 1% rent increases in an environment where the last 3 years inflation's been up 20% cumulative.
Yeah.
So all of these, if you're a owner of a rent controlled apartment, your income has gone down dramatically. Now your loan costs have gone up materially. So they had a huge problem, have a huge problem of these loans. I honestly don't know why the new management isn't more nervous. There's going to be a wave of losses on these unless something miraculous happens.
Did you listen to their call, the one in January?
Oh my God. That one was good. Yeah.
So there was an analyst that reamed the CEO on the call, and we were playing it in the group, in the community. It was awesome.
I actually recommend, if you want, a little bit of entertainment, go to the Q&A section of it and just listen to the analyst. He does not, he's not happy.
Yeah, that's
I think it must
not
be
how you get paid as an analyst, is humiliating the company, but it sounds like fun.
Yeah.
Oh my God.
I think it was it the analyst from JP Morgan?
Really?
I'm pretty sure it was. Wait, I think we need to fact check that, but the NYCB analyst, that was not, because it was, I get what happened, right? All of the estimates were going to be wrong, and they had nothing to guide. They had nothing. The management team was like,
honestly, in that case, I can't blame them. I wouldn't be guiding either. Because it's really bad and it's uncertain. And I personally think they merged with 2 other banks over the last 2 years. I think they were doing that to dilute this problem.
Yep.
make it a smaller part, because the problem isn't going away, but make it a smaller part of the total assets. And they'll be struggling with this, I think, for years. I have a good friend who's very knowledgeable in the New York City apartment business, and he said it's an absolute disaster. I was thinking of buying the stock, and he talked me out of it.
Oh, NYCB?
Yeah. Once it got hit, it got down to 4. Actually, I bought a little of it, and he said, don't sell it. And it went up to 4.5 or something. I said, he's an idiot. And then said, okay, I'll sell it. And the rest of the news came out.
Do you think was it Steve Mnuchin can save it?
I mean, he's a smart guy. I would think there's a big challenge. I'm a little surprised they seemed as confident as they were in the long-term future, but it's possible. If they get enough capital and can, the losses in these apartments are going to be serious, but maybe not overwhelming. There's something at the end. Yeah, I wouldn't want to make that call. That would require a lot of analysis of how bad that apartment thing is going to be. Yeah, so I'm a value investor. It's tough to value.
Trying to find this one. I don't think I'll find it in time. Otherwise,
so actually, I only got about 5 minutes or so here. So,
okay, no worries.
Okay.
So, just to wrap up, what in your experience right now is something that investors could learn from the periods of crisis that you went through, particularly the dot-com bubble and the Great Recession, as far as more paying attention to, let's call risk, because we want to focus on our downside rather than opportunity?
Right. Well, I would say the things we've talked about already, but hype matters. We saw a tremendous amount of hype in the internet days. I mentioned that Next Card is one of the hypes. So beware of hype. And certainly the financial crisis was very much about pay attention to lending standards. Understand the risks that you're taking. Those lending standards were just completely ignored. If you haven't seen The Big Short or read The Big Short, they did a pretty good job of explaining it, and you can see the dazzling underwriting mistakes. So those certainly were the lessons, 2 of the lessons I got out of those events.
Perfect. All right. Well, Gary, I don't know, Dan, if you have any last questions for Gary.
Do you want to do an after hours?
Yeah. We'll stay on, and we'll kind of discuss with everyone, answer any further questions people might have.
So what do you remember about .com? I guess any stories? Because I was in high school. I started investing, and I got cut in half.
Yeah. Well, my next card is one of my favorites. There's another one called bank called NetBank. So this is, again, the early days of the internet, and it's going to be hard for you to even grasp how stupid we were. So NetBanks, we're an internet bank, meant literally that they had a website. So, we talked before about banking price to book is a useful figure. So at the time, banks weren't much more than, 1 times book. This company got to 10 times book because they were an internet bank. Literally that 9 times extra book was something like $1 billion. It was a pretty small bank. So they basically, investors are paying $1 billion for a website, which today would be what, $500, $1,000 to build. And along the way, so the book was about 10, the stock got to 60, and the CEO comes out and announces he's selling 1/3 of his stock. Within 3 days after that $60 stock hit 100. Those were fun days.
Oh my God.
And
I'm jealous.
They sold out for somewhere below book eventually.
The banking sector didn't do too badly, did it, during
No, that wasn't. I mean, there was a lot of bad loans in the build out of the internet, but I mean, the valuation, people, I mean, I wasn't following banks, I was following non-bank financials, so investors stopped wanting to see me. Nobody had interest in anything but internet related stocks. So they were just ignored. They didn't do anything stupid. And they actually, I think the best year I ever had as an investor was the year when they have the year, either the internet bubble burst or the year after, when investors said, okay, maybe we better move our money out of tech into something else. They came back to them.
I have a quick story for you. Well, I was going to say, so I was in Afghanistan during the Great Recession. So I really didn't know what was going on. I come back in February of 2009, and I've got like $65,000. And I'm like, I instantly put my investor hat back on. I kind of get an idea of what's going on. And I'm like, okay, I think we're recovering. So I'm like, let's go Caterpillar and copper miners, because if we're recovering, they're going to start building. I dumped like 80% of my money into those and like tripled in a month and a half or so.
Awesome.
I mean, just timing, right?
Really?
Just time and place. It was,
good for you.
Amazing. Yeah.
I got to plug in that that financial theory that Bacon loves. It's portfolio rebalancing, timing, luck. You were you experienced that for sure.
Yeah. Really? Well, this business, take the luck when you can get it, right?
Oh yeah.
Luck makes money too sometimes.
Right. Yeah.
Well, to all our audience members, thank Gary for coming on here tonight.
Okay,
and
thank you.
Thank you so
a lot
much.
of our questions.
Yeah,
by the way, everyone, check the description for the links to Seeking Alpha articles. If you want to read more on Gary's work,
I'll link it
feel free to link it. Yeah. And yeah, thank you again, Gary, for coming on. We really enjoyed this conversation. If you ever want to come on for another conversation, we're more than welcome to set that up.
Okay, I'll leave you to invite me, but happy to do it again.
Oh, no worries. Thank you.
Okay, take care.
Bye, Gary.
Bye.
So as we kind of continue on with the live stream, you guys can ask us whatever questions you guys want. I guess to digest, me and Dan, what do you come out of this, thinking about banking, SoFi?
I think never got to the mortgage questions, but I knew it was too long, but
we could definitely have him on again for mortgage related questions.
He covers mortgage companies, so that might be for people here, and banks. And his success rate on those articles is pretty good. Like, because you can track people's articles right on Seeking Alpha. So this guy knows his stuff. But
yeah, I'd love to have him on specifically just to talk about the mortgage business, some mortgage REITs in particular. And rocket companies.
Yeah, that's the one I want to hear about. I think people should take from this, though, that he's like, he really was adamant to say, like, there's a lot of banks that want to grow fast and they have some sort of new angle they want to tell you that they figured out because they're all chartered banks and they're going to grow fast and show you they're growing. And then, like, I didn't know the part till he said 80-90% of them go bankrupt. It doesn't work. And there is no competitive advantage. And I just think a lot of people are going to get hurt by SoFi. And it's a shame because I don't understand. I'm not even that, like, I'm an auditor, but I'm not a financial expert, but like I could see it in SoFi a year ago. And I know all the people online are going to say they bought it at $4 and they're making money. Because that's what everything I always get that from these SoFi people that comment. They all tell me that they bought it at the lows, right? No one bought it at $12-15, which we know is not true. But I think they cope too much. Like, it got wrecked on earnings, and you should look at that and say, why did it go down 15% on earnings? Something there should be red flags. Something's wrong. And the market knows what a bank is, people. Like,
on a high level, I mean, usually I thought it was common sense somewhat to be hesitant on investments that are heavily crowded by retail investors. I thought that was more common knowledge than apparently maybe people know that and then they ignore that, general rule of thumb when it comes to certain stocks. And they're just like, yeah, I know, be fearful when others are greedy, greedy when others are fearful. And that's not referring to necessarily the stock price. That's not what it's referring to. But people take it means the stock price. If the stock price is down, that means people are just fearful. That frame of reference is mainly gearing towards how the general sentiment of a certain population is. And retail investors tend to be serial underperformers as a cohort. So take that what you may. If you don't even, if you view it as the point of view of like retail investors, they tend to get emotional or excited about certain stocks, and the cult stock phenomena is not new. If you're a younger investor, this is new to you. But if you talk to, I imagine, I mean, Gary hinted at that in his experience throughout his career. He's probably seen tons of cult stocks. So it's not a new phenomenon. We're going to continue to observe it. When all of you guys are then going to be older and experienced investors, you're going to see the next one. And then you're also going to say the same thing. And those people are going to tell you the same thing. You don't get it. You don't this, you don't that. Now, there can be some retail investor hype stocks that do well, and we'll point to those, survivorship bias. But for every one success, there's going to be a massive graveyard. And then so in aggregate, the cohort is not going to be doing too well. So some of the things that we discussed here today, I think to highlight, and I think that's what this segment should be, is look at the fair value. I love that conversation. Like, why is that an issue? Why should that at the very most, or at least, concern you? You should ask a question and go, why are they doing that? And then some of the other points, the commoditization of the business. So these things are not, I don't think they're really disputable at this point. At any point, they weren't disputable. Like, money is commoditized. Banking is a commoditized product. So, and I found it very interesting, the conversation on the cost association, or where the cost contributions are going. That part was very interesting for me, at least. I think for you, Dan, as well. Like you've talked about that in the past with me, and because you've been following Gary's work for a little bit more than me. Not a little bit, a lot more than me.
Like, he's literally the only person that said sell in Seeking Alpha of all the articles written, and he has gotten, like, the comments against him have not been fair. People are like have gone at him, but he's been right, and he's been right for this whole time. And I think people should listen to him just because he said, he admits he doesn't understand Galileo, but he understands the banking business, and SoFi is a bank by just the sheer volume of their business in the banking compared to this technology business, which is growing very unimpressively. I'll keep saying that. And it just feels like SoFi is just filling the voids that the big banks don't want to be in, right? And I think they're just, once they try and enter a space, we look at housing, they're trying to enter housing. It's really not growing, right? Credit cards, I think they're going to hit roadblocks in a lot of these businesses they want to go into, where competition, like Gary said, competition is brutal in this business. So they can keep growing in the spaces that the big players don't want to be in, personal loans. But that's not an investable thesis, I don't think.
That's the comment that I will want to pin all the time, right? When they are trying to grow in business segments where the other players really want to be in, what are we observing with the growth rates in those products?
That's what I would, if they were to be successful, I would tell, that's what you would see. Substantial gains in non-personal loan businesses. And they desperately want to show you that in their presentations, but I think they're being a little manipulative with what they're showing.
Yeah. And again, going back to that fair value calculation, not illegal, nothing like that, but interesting to choose to do that. That's it. It should spark more questions and doesn't really provide any answers, if anything. I would love for them to provide more answers, and I'd love to then look at those answers and say, well, yeah, how is that doing? So, yeah, I do want to have them back on for the mortgage conversation at some point. Any other questions or highlights? Someone wanted us to talk about Meta. I don't throw Meta into here. We did
Zuckerberg is still a lizard man.
This was a great question. I'll ask him next time. This was another great question on Fintech, and this was another great question. Yeah. So,
and the one point he did make, he said he wasn't opposed to valuing them as a technology company if that became a substantial part of their business.
earnings.
right? Yeah. So, which it's not, not even close yet.
Yeah, and arguably that's a point where if you're actually considering this seriously, that is the one avenue where I say it's the unknown. And I maintain that. We've maintained that since last year when we first covered SoFi publicly. It's you better believe you the only logical framework in which I can establish a bull thesis for SoFi is you truly believe in the success of the tech stack, the tech platform taking off to a big degree. Because then you don't even have to bet on the actual banking business doing well, their banking business. You just have to bet on their customers. As their customers grow, those accounts at Galileo grow. Presumably, the fees that they'll generate will also grow, and they'll make they can achieve success there. So if you believe that, then I think you have a logically consistent framework to be bullish. But if
he made what
you're
he said, it's not about the revenue, it's about like the actual profits. Which
profits,
Galileo revenue growth was fast, and then I'd look at like contributions to profit not growing at all or barely. So like I'm like, well, are they just giving the product to people and offering big discounts? It's unclear at that point. But it
exactly,
wasn't substantially growing as far as the profits from it.
exactly. It's a lot
So
of
they're
question.
again, they are pushing the narrative of growth. SoFi is pushing you on this growth narrative, and they're going to do it to the bitter end. Right? Everything they want to show you is growth metrics. Look at their presentation. Anything they can find that shows growth, they're going to put it on that PowerPoint.
Yep.
But that's not their financials, people. It's not. It's a presentation.
So. Yep. So just to be clear, Dan, you're really long SoFi. I had to throw in one gaslight.
I mean, we could swing trade it again. I guess we'll have to watch it.
We have to look for another identifiable catalyst.
Like we said, there's a present value we both kind of have. I think it's pretty close.
Yes.
For it, but I don't know.
Yeah, I don't see now as far as banks go, are there any, because the title of this live stream is banks, right? So are there any banks that you find interesting right now, or you kind of in general are avoiding banks for the time being?
I mean, New York community is kind of interesting.
From a real degen kind of turnaround? Yeah.
Like you really want to speculate, like if they succeed, right, in pulling them out of this misery, and they deal with the the loans to the rental units, you could do well with it. So, but that's the big unknown. So.
Yeah, I'd view the big unknown with NYCB. I mean, there's a lot. It's arguably, like in some cases, it's a black box. But you have some new management coming in that has reputation, so yeah, you can play that. The one I'd say that is always fascinating to me, and I think it's recently run up. But American Express, which I find that business phenomenal, on a variety of key points. But they're technically a bank. No, they are a bank, not technically a bank. I found it weird that they didn't want to acquire First Republic, by the way, to get access to all those relationships. I know JP Morgan bought it, and that was like picking up pennies on the dollar because they didn't have liquidity risk, and so they could definitely absorb that. Maybe I'm not familiar enough with the state of American Express to swallow up First Republic, but I found it strange that maybe they did, and I just don't know again. But I thought it would have been an interesting way, because I hear American Express's desire to go more in that direction that was reminiscent of First Republic's target group, which is trying to target high net worth individuals' banking needs. And they have a consumer banking arm that maybe people are familiar with and have a relationship with American Express on that front. But yeah,
Do you think the government just gave First Republic to Jamie Dimon?
I think that's.
I think he hints that in his annual letter.
Yeah,
the way he kind of writes about, because I was reading his letter a few weeks ago and kind of seemed like it, which is what I made money on trading. I thought he would swoop in on First Republic. So.
Yeah, and he won there, or JP Morgan investors won that battle for sure. Wells Fargo trade seems to be working. I know you hate Wells Fargo for a good reason, though, for a very good reason. But Charlie Sharp, he's doing a good job, it seems.
I mean, yeah, if it works like you would if they get that limit removed at the time when, you do very well with it. So far they're coming back, right? But how another scandal could hit them at any time. I guess the question, do you believe they have changed culturally?
Do you believe the management?
I'm not willing to take that leap, but
well, I don't have any money in it right now, and I regretfully, because I had it and it's sold too early. But anyways, confirm nor deny.
Mitch McConnell has a lot of Wells Fargo stock. He was buying it last few years. That dude killed it.
Okay, so Citigroup, how would Citigroup get out of their slump? That's a restructure play. Citigroup below book is not enough information to go off of because they deserve to be the cheapest of the big four banks. So they have the lowest internal return metrics. So the current CEO, what she's trying to do is she's trying to fix that. There's a lot of counterparty risk that's hard to take into account. Counterparty risk is very much, we didn't get into that with Gary, but counterparty risk is something for banks that frankly is not discussed about enough. So Citigroup still has probably among the higher amounts of counterparty risk that I can identify. Oh, sorry, not identify, and that's actually a problem. Technically not identify. All right. As far as other investments go, I will talk about Meta briefly because someone asked. But I still like Meta. I like what they're doing. You're not going to be happy with my answer because I'm trying to keep it to the conversation at hand. Meta's good. I like it. I have bought more on the dip for the first time in a long time. That's all I'll say. If you have any very specific questions on it, I'll get into it. But as far as that goes, there's another live stream you could go back and watch on Meta. So this is a question I have for you, Dan. I have my own spin on this, and I would like to then share mine. But what part of this ecosystem, and I'm saying ecosystem of companies, do you particularly have an interest in playing in the financial space? I have a list of companies that I want to own, and I'm not going to say American Express again. I've already said them, but there are a couple others that I find to be the most interesting. To lump it up, you have PayPal, Sofi, all the banks.
So there are companies that do primary or title insurance, PMI insurance. Kind of interested in them. If housing recovers, I guess.
Okay. What was that ticker again, or bank company type?
So there's companies out there that are part of providing primary mortgage insurance, PMI.
PMI.
And also title insurance, right?
Title insurance.
That's the one I really would like. There's I think it's FNF.
Mm-hmm.
It ripped last fall when everyone expected this year, right? March would be interest rates dropping and all that crap. So it shot up. So I'm kind of watching to see if it does some sort of downtrend again. But it's like a business based on volume. So
very
the more houses are sold, the more title insurance fees they get. Stuff like that would be, I guess, if you're talking about finance companies and housing.
Yeah.
I don't know if I'm competent enough the mortgage companies.
Like the mortgage REITs or
the MREITs and stuff. I don't think that's my thing anymore, but
yeah, mortgage REITs that's a conversation we could definitely have with Gary about mortgage REITs. And some of the mortgage wholesalers too, some of the originator businesses. I mean, you have a bunch that are public traded. You have originators. I think you have Mr. Cooper. Wholesalers, you have UWMC, Rocket Mortgage. Rocket Mortgage also does origination. Those are the ones that come off the top of my head. But
Mr. Cooper bought my mortgage last year.
Oh, did they?
So I looked them up. I'm like, wow, they're doing pretty well, actually.
Yes.
What is this business?
Because they do well on not the origination per se. They do a lot of their income from the servicing of the mortgages. So their servicing business has done really well. I don't follow Mr.
I'm
Cooper.
paying for it, I guess. So
Yeah, yeah. Oh, and the bank is, or whoever owns it, maybe it's tied up in a security somewhere, but they're paying Mr. Cooper for the right as like the custodian, and they're managing it on behalf of those guys. But yeah, that business taken off. Trying to think of to answer the question, the places that I find strong interest in is actually in the Fintech Kings. You know who I'm talking about, right? The actual fintechs with insane moat and no one can challenge.
What the other Fidelity, FIS?
No. The true Fintech Kings, the biggest ones in the game, MasterCard, Visa. Oh, I love those guys. So I've been actually doing some digging, and I always get to the point where I'm like, which one? They're both really good, but like, which one do you go for at the end of the day? I think I'd have to go with Visa. There's a couple reasons. I'm not entirely sure how much this is going to be true in the future, but it does seem like MasterCard is shifting their narrative on growth right now. In the near term, they're going to try to focus it on China. They had it in India. They're going to focus on China. Visa is so MasterCard. Rule of thumb when you're thinking about high level on these companies is MasterCard is the more international player. Visa is the more North American centric, but they're split 50-50. So Visa is like six point something bill US North America, and then 6 point something bill rest of the world. MasterCard is majority world and then has a US component. So I feel more comfortable with Visa, but they're both great. Like I'm finding a reason to, like, you got to understand, I'm trying to find something to ding MasterCard on. It's not that it's a valid reason. It's just like I'm trying to find something. I'm just trying to like this is something that so you have businesses that have, in every sense of the word, a true moat. And I mean, guys, if you guys haven't seen, pull up any of their internal return metrics. It's absolutely insane. You'll never see it on another business like that again. Like net income margins. Have you ever seen a business with 50% net income margins? That's been consistent.
I know. Yeah. I'm looking. It's crazy.
It's insane. Really strong return on invested capital, really strong return on equity. And if you're a fan of businesses that literally have nothing else to, really invest in, or they have a lot of excess free cash flow, and guess what they do with it? They just return it back to you. Look no further than Visa and MasterCard. Quite literally, probably you could argue inflation immune businesses. It's just all volume. And it's low cost volume, by the way. They're already basically like the cheapest rails. Well, they are the cheapest rails out there. So that's the incentive to use Visa and MasterCard. If you don't find cheaper rails, they have the scale that no one else can match. So, yeah.
You do hear so the dean of valuation guy, Aswath. Is it Aswath or
Aswath?
Aswath. He was on some podcast, I think, and I heard him say that he did a study where he looked at like all the return on invested capital for like every company in the US or world. I don't remember. And then he was raving about how there's nothing significant or substantial about that metric. So he's kind of pointing towards like it doesn't mean anything. And I'm like, I don't know. I almost want to make a video about that because that's a weird statement to make. Like, should you take a metric and apply it to like every company? Like, I think that's the wrong way to approach this metric. You should use this metric in meaningful ways, looking at comparative analysis, like companies that are like direct competitors, maybe.
Yeah, he's said some things lately, especially that I vehemently disagree with.
I don't agree with that take. I mean, I when I heard him say that, I was like,
yeah, that's a weird one. He said that it doesn't matter, blanket statement. Return on invested capital does not matter.
I'd have to pull it.
Yeah. You could argue, right, looking at return on invested capital for, I don't know, a car business, and then you look at Visa and you're like, oh, they're based off of this metric, Visa is the better investment right now. Yeah, I'd push back on that, but to say that, you know, you look at one car company return on invested capital, another car company return on invested capital, and then that somehow doesn't mean anything. Again, you kind of go into the financial statements when you're doing your analysis. You try to find if there's any nuances that you kind of have to pick apart, break apart, and then rebuild. That can happen because there can be like one-time things occurring and, you know, changing up some things. But assuming all that's squared away, that the hard part's done, and you're looking at an apples to apples comparison, I don't agree with that at all. I think that that's a fair way to exactly what you said, comparative analysis.
Yeah. Like what like MasterCard 50% ROIC. Like what does that have to do with Caterpillar? Say returns 18%. But that's Caterpillar is doing amazing, right? Different businesses. You can't like the metrics have to have meaningful comparison value. Well, I just these economics people always think they got all the answers, and like are the richest men in the world that you know, professors in economics? I don't think.
You're getting into that academic side. The academics, do they, if they are they somehow more aware of something than the people who either have the working experience or are currently working, or have made their success from a set activity? So yeah, because you have, I mean, you can look at the metrics that can be different in the formula of return on invested capital, right? It could be that the invested capital portion is, they're different businesses. So the denominator is going to be different, or the numerator is going to be different. Maybe one company has a lot more, let's say, average invested capital because it's more capital intensive business. Happens. They sometimes get disrupted by other competition offering cheaper transaction fees. Yes, but you got to find that. The difficulty is getting started and then getting to that point, while the big boys, I mean, they charge basically nothing. You understand, like the transaction fees that you see, Visa and MasterCard are like not the one that you're concerned about. Everyone builds their stuff on Visa and MasterCard rails because they're so cheap. American Express has their own rails, but that's their own ecosystem. If American Express, if you view their rails as in a competitive standpoint from Visa and MasterCard, there's probably no reason you would use Visa and American Express. American Express's rails work good for them. But if you're a bank that doesn't want to build out that network, you got Visa and MasterCard, and they don't really charge much.
Oh, here's a question. So how would Zelle become a public company if they don't offer some sort of assurance or guardrails? Like, because when I send Zelle money, right, it says once you send that money, it's gone. You can't pull it back. There's no like backtracking if you sent it the wrong person. I'm like, because people are excited, some of them, about like if that became a public traded company. I'm like, I don't know how they do that as a separate business, like publicly traded.
You saying because what, regulators would come in and smack them, or?
I don't. Do you think, as a standalone business, do you think that makes sense on the public market? Like, how do you just say, oh, if you send your money to the wrong person, tough crap. Don't do that again. But
I mean, that would maybe already be a concern if it was a concern, right? Because public or private, that'd be a concern for regulators, which I guess isn't, because they tell you.
Yes,
they say, make sure, is this the person you want to send money?
You have to check. Like I think he clicked 3 times. The one through USA, they're like, "Are you sure? Are you really sure this is who you want to send the money to?" But
and you know how Zelle makes money, right? It's very interesting because they don't charge you fees. They charge the bank.
Have to charge the bank then, right?
Yeah,
they don't charge me. So
yeah, the bank is their customer.
Okay, no.
So you don't see any of those costs. That is what the bank pays for. They pay Zelle to use their service, and Zelle then benefits from the network effect. And honestly, I think if it went public, that's going to be a very pricey stock, because I can almost guarantee you, I mean, what other way does it go through? They pretty much have every bank.
Mm-hmm.
It's it's probably going to trade at a very pricey multiple. It's going to be, that's the way MasterCard started. Visa came from Bank of America.
Yes.
And MasterCard came from a bunch of banks, and they IPO'd their ownership in it. Zelle would be like the repeat of that story. I'd be pretty interested probably in Zelle. The one I don't understand is, and frankly, again, because June says it right here, and I think this comment, I'll bring her comment up. I don't know enough about FICO because I don't understand what the moat is keeping everyone else out of it. I have to learn more. I don't understand enough of it. If someone in the comments, I know it's like something that would be too hard to explain in the comment section, but I need to rectify this ignorance because it trades at an insane multiple.
Yeah. Oh my God.
And I haven't wrapped my head around why FICO is so good, so amazing. I see the moat behind, TransUnion, Equifax, and the like. But I don't get FICOs because FICOs just aggregates those scores. They're not making the score. And so I see why the credit bureaus, their moat's there because the government comes in and says like, yeah, every single mortgage, you have to do all three. There's no, you pick and choose. You have to do all three. Credit cards, you don't have to do all three. Mortgages, you have to. Oh my gosh. Every time you have a regulator enforcing your existence, oh, I love that scenario. I love to be the business that is in that scenario. The government is enforcing my use. Like, you have to use me. It doesn't matter what my competitors do. And it's a better scenario than car insurance. Because, car insurance in I think almost all the United States, if not all the United States, you are by law required to have car insurance if you own a vehicle and you're driving it. You have to have car insurance. So it's a good business for the insurers. But the difference is now it's competitive because I can choose which insurer. With the mortgage business, it's like, no, I got to use all of you. I can't go TransUnion, Equifax, and ignore the other one. I got to use all three. FICO, man, I need to learn more about FICO. I don't get it. So, yeah, I regret not buying TransUnion though. It was a really good value not too long ago. How do you feel about Home Depot? I'm turning the conversation completely 180 from what we're talking about. But how do you feel about Home Depot? Like, I've been looking at this business for a good part about 30 minutes.
Really?
Yeah, genuinely.
So, I looked at it a little bit. It's a core holding, but it's one of my smaller ones. But I don't know if I like them buying that. Was it, if I remember, the wholesaler supplier?
You don't like that?
I don't know what to think of it yet. This is radically, like, Home Depot doesn't do this, right? They just run the Home Depot stores. They're the source for professionals, contractors. This is like, I understand why what they said, why they did it. I don't know. I think that's part of it. It is sold off a little bit. So
it has pulled the back a tad bit.
I get they want to control, I think, some of the pricing and the supplies of the professional business.
Oh yeah, which I really,
because that is Home Depot. It's not me going there to get PVC or a 2x4. That's not the business. So
yeah, isn't it 50% or just now over 50% is professional? And so people, when they think of Home Depot, they go the store, but it's exactly what you said. It's the professional. Because I know some businesses, private businesses, that deal a lot with Home Depot and Home Depot competitors, and I can attest to the utter strength of Home Depot Pro. It's really strong business.
Yeah,
and really a nightmare if you're competing against them.
And like, they're just phenomenally good at allocating capital because they've always known what they are and they've stuck to it. I never bought Lowe's getting into their business. I never bought it.
Lowe's is also more.
Lowe's would tell you they're cutting into that professional business, but I don't buy it.
It's tough. It's really tough.
Yeah.
The part that I really like about Home Depot versus Lowe's is more guilty of this. I think Home Depot recently did this a tad bit, but nowhere near Lowe's. Lowe's was borrowing money to buy back shares.
Mm-hmm.
It was.
You could see it.
Yeah. Yeah, Home Depot, I think, has better management team. And there's a separate episode. I probably want to have this conversation because I got into an interesting conversation with other people about this. But I want to hear your thoughts. Maybe we can get into it. Do you have time, Dan? I don't want to be encroaching on your time.
Yeah, go longer.
Okay, so I had this friendly debate with people recently, and it's about what makes a good business. And I think, in particular, one of the conversations was stemming around making it a good place for people to work. I argue that one of the main ingredients of any good business, and by extension, a good investment, is a place or a business that is very good at attracting talent and retaining talent for a variety of reasons. If you guys own and manage your own business, or you're a manager, you might see this in your own organization where, talent coming in and out of the business is very inefficient, very costly. And if you're trying to compete in a competitive marketplace, getting that good talent, keyword good talent, is very crucial. And so when I look at companies like Home Depot, I actually was proposing the question to the people I was discussing this with is like, help me find a good business that people or talent doesn't really aspire to go to. That would be, I think, the challenge, because I can find plenty of good businesses, good investments that have generated insane rates of return for shareholders, and all of them, I tend to find that as being a commonality that they also have, because people have this misconception, in my view, that businesses have to screw over their employees. That's like the inherent existence of corporations, to screw their employees and screw their workers and make it a miserable place for people to work. I don't view it that way. I see that all the companies that I see as fantastic businesses is like, no, people like say, I like working at Home Depot. I like working at Costco. I like working at their aspirational jobs in that category. Of course, you can't compare apples to apples. To finish off the point, like, you can't say, I'm looking at the food service business, and that's supposed to be equal in comparison to quality as a software engineer at Alphabet. It's like, no. Within the software engineering space, how does Alphabet compare to other software engineering firms, as an example?
I'll tell you, so like Walmart, Home Depot are really good at like promoting from within. So someone comes in as an associate, then you can like become an assistant department head, assistant store manager. Store managers make, I believe, 6 figures a year at Home Depot. So they have, there is a way for people to move up in the business. And I worked at Home Depot for like 6 months.
Oh, that's good to know.
Just between military assignments. So it was fine. I was treated well.
Yeah, so like, as an example, how I'm trying to pinpoint this comparison within stores like Home Depot, is Home Depot the place that people who are looking for a job in that space, apples to apples comparison, would they choose Home Depot over the competition? Because someone brings up this point, right? But look here, break it down this way. Do people still, does talent overwhelmingly want to work at Amazon? If the answer is yes, they're doing something that makes it attractive, because the choice for working at a place is affected by a variety of factors. One of them being pay, right? Are they paying you very, very well? That is why you're applying there in the first place. Like, what is drawing you to apply to that business? My argument is that all the great businesses that we can look at case studies, all of them, they have that commonality. There's something about them within that space that people are saying, I would rather work there, or I'm seeking a job there, than maybe some of the other competitors. So I'd argue, and I think most people would argue, that Amazon to this day, and all tech, as Chen says down here, that's all tech firms, they're all doing something that they don't have a problem with applications. That's not their problem. But I'd argue a bad company, one of the things that you'll see as a commonality is that you might see talent flight from them. People, the good talent, they're like, no, I'm not working there. I'm dipping. We know some companies, IBM is one of them. Intel is another one. So yeah, looking at one of the things that I'm with this conversation is I think it's a good point. You know how ESG is bastardized, Dan, or do you think that? Or I don't want to jump the gun here.
I don't know. I haven't really thought of it
I
too
think
much.
that the high level principle of ESG made sense. It's in some degree, right? Environmental, social governance. If you have a company that is environmentally cautious, there may be less litigations in the future, right? To think about that. If they're socially conscious, maybe they're treating their employees well, because that's part of this component I'm talking about. If their governance is good, they may not have a lot of insiders that may not be aligned with shareholders. Like the concept on a high level was good to some capacity, and it was completely bastardized in my view. Like now it's been taken to an extent that it doesn't make sense. But as investors, we should have realistically always been looking at those three factors, right? But maybe not in the way that it's used right now. So like, I hope my business that I'm investing in isn't grabbing vats of toxic waste and just dumping it into people's drinking water. I think that's a problem or bad business practice, and you will make less money, not more money. And then simultaneously, if I'm looking at a business, I hope that they are providing an environment that they can get people to say, I'm going to put my job application to this company because I want to work for them. That's one thing. And also the third factor, governance. I hope that I'm buying into a business where there isn't some sort of weird structure that no matter what, the founder, CEO can, protect himself completely and issue it. For example, there are some structures out there. Issuance of new common stock doesn't dilute them because they have a special kind of common stock, or not a common stock. They have another kind of preferred stock, and then you're kind of diluted to hell. That's the governance side. But yeah,
I think it probably started well intentioned, and then BlackRock packaged it for public consumption, right? And maybe then ballooned into something it wasn't originally.
Yes.
Which, like moat is a packaged product from Morningstar based on a comment Warren Buffett said. So literally these companies will package something that they think they can make money on. I think that's part of what ESG kind of became.
Yes. Yeah.
Maybe it was just originally the ES, and then all of a sudden someone said we got to have governance, whatever that is, included.
Yeah. No, and again, and like on a high level, we're all technically doing that thing, but yeah, the way it's implemented today is I like ESG as discussed in common discussions. I'm not that. I'm not an ESG investor. I am an investor that does care about my company is not dumping toxic waste. I am an investor that cares about, I view as a success factor, having the attraction of talent. And I do care about the structure of ownership. All of us do, though. So it's like,
I mean, we all have a red line somewhere.
Yeah.
Investing. I have mine. I've said before, companies I just won't invest in, and it's not this. It'll never mesh with other people. So that's the problem with ESG, right? That's an artificially created red line that most people wouldn't agree with.
This comment. Okay, this is a great example. Right now, Boeing. What does talent think about working at Boeing?
I mean, the union people probably just have good union benefits, but like, I can't imagine management people feel good about working there.
Do you think Boeing's a great company?
It's a terrible company. It's a monstrosity of a company in America. Like, it's sad, but I've said it's an evil company for a while. So
yeah. So that's genuinely how
I would tell people, don't think it's a turnaround play. It's not a turnaround play yet. Just because the stock's gotten punished, that's not the definition of a turnaround.
Here we have another.
It could get to that point, like Fabio and me, where we got Disney. I would argue we did pretty well with that. So
yes, we did very well.
There were characteristics of Disney that made it a turnaround play, not just the stock went down.
Yes,
things management told us, and we trust they did it. Boeing, you're not there yet. You're not even close to there yet.
even this comment, right? Here's my point. You cannot compare. It has to be apples to apples. So Amazon does not seem to be, for whatever reason, we have to contend with this fact. They do not have a problem finding people who are wanting to work in the environments that we're saying here in this comment are bad. Why? Why is that? What about it? Because if it's literally a job that no one wants to do, they should, in theory, then we should be observing some sort of big problem occurring there with them being able to acquire and retain talent in that section. At some point, they'll go through all of America at that point, because I think it's like what, over 1 million people. And if the churn rate is that bad, then they're going to have a huge problem, and you should definitely not invest in the stock, because then there's going to be a problem there. Or is it maybe a little bit exaggerated? Maybe that it's sensationalized in a big capacity. Comparatively speaking, because you have to do an apples to apples comparison, is the job there a better off position than another job comparatively at another firm? And then why is that the case that Amazon does not seem to be having the problem acquiring people there? Is it the pay is better? I think the pay is like, I want to say it's on average $18 an hour, something along those lines. And so is the pay better? Does that overcome maybe the longer hours worked? Maybe the hours worked is a positive if it's hourly, and some people complain about not having enough hours at certain places. Like, what's going on there? That's something I want to dig to. I don't know the answer. I'm saying that it's something that maybe we should dig a little bit deeper, because if the conclusion is that it's not good, then we should probably be observing certain outcomes that I don't see yet, which makes me want to question it further and investigate further and add that extra layer of nuance. Because it's very easy to grab an article and say, Amazon, blah, 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 trash, but then not question it further than there. And as an investor, we can't do that. I always joke around, but very seriously, if you are investing based off of the opinions of a journalist major, you should not invest. You should index completely, and then enjoy the articles that you read and get your information from that, because that's, the level of thought going into certain things. Oh crap, Bacon, if you could remind me the phenomena that we always talk about, Gelman's amnesia. The moment that you're familiar with a topic and you listen to a journalist major talk about that topic, and then you realize that they're not very well versed in that topic, and then you forget about that experience that you just had, and then trust them for other topics that you're not familiar with. It's called Gelman's amnesia. You should avoid that. We have people, beater stocks. That's the actual thing. I do know people who are working there in the club, and they don't tell me that it's that bad. That's the thing. So you need to add nuance to the commentary. It has to be not it tends to be that the popular uninvestigated opinion is not the correct opinion. And that's obviously, as an investor, you should appreciate that, beater stocks. If you're taking the popular opinion as fact, or the most common opinion, without further investigation or questions, then we can find ourselves in a situation where we might be putting our money, which now there's a material impact on being wrong, in the wrong position. We might be avoiding a company that we otherwise shouldn't avoid. We might be invested in a company that we otherwise should not be invested in, right? So remember, with investing, and I take this approach a little bit more outside of investing too, because for some reason I don't want to apply a different standard to things that just because my money's not on the line, I just will have a lower standard. Of course, I'm not going to be like, oh, you must be a stickler for everything. And no, there's levels of where we can say, okay, I'm going to take a step back. I just don't know. I don't care too much about the topic to debate it. So in principle, AWS enjoys it, but acknowledges that there are lots of policies and bureaucracy near the top, and also cultural fit. They will boot you. No, yeah, absolutely. But do people? That's not what I'm necessarily talking about. Churn rate of like them firing people is actually quite the opposite. It's like that means you have more people wanting to work for you than you have positions available at the company. That's a good position to be in. Mm-hmm. You must be doing something right. It's a multitude of factors. The pay is ridiculous. The hours are great. The culture is good, or all of the above. right? People don't just choose to work at one place for just only one reason, and everyone else's like opinions don't matter. There's a multitude of factors that we have to look at, and then sometimes one factor overwhelms another factor. Investment banking, for the most part, on average, is a pretty sucky job, but a lot of people want to do it. Why? Because the pay factor overwhelms the other parts. So, yeah. Focus now better. Oh, no, I don't. Can you imagine? But yeah. Okay, yeah, there we go. But you're right. There is never a shortage of applicants. The problem is finding qualified applicants. They're not handing out 300. Yeah. They're doing something that they are getting a flood of applicants. And that's my point. Great companies will not have a problem attracting talent. And that's very important. Talent is very important. It's the lifeblood of any business. If you can't find talent, it's parts of the inputs of capital. That's one of them. Land, labor, capital. It's inputs of production. If you don't have it, and also you need to make sure that once you find the person that's the fit, make sure they're happy. Don't let them go. Increase in those variety of factors. Increase the pay a lot. Fulfillment in a job. That's like there's actually so many factors. I can't list them all. I just listed 3, but there's so many factors that go into the satisfaction of a job. And then one of those factors, depending on the person, overwhelms the others. Some people are very pay focused. Some people are work-life balance focused. Some people are, if they're growing in the business, not growing in the business in the sense of like they're learning a lot. There's people, if you talk to them, they'll say, oh, but I'm not learning anything new. And then for you, that might be like, I don't care. You're getting paid, I don't know, $400,000 a year. Why do you care if you're learning? And then they'll take a job elsewhere with a lower pay, but they feel like they're finding fulfillment in those other factors. And then there's also like the stages of life that someone's going through. When you're older, you care about other things. When you're younger, you care about other things. We're getting into the point. Point is, you have businesses that I find to be of esteemed quality. None of them have, within what they're competing in, have a problem with finding talent. I don't know if there's a debate to be had. I think Dan's just nodding his head because he's like, yes.
You and me are accountants. We always have work.
Yeah.
I've never had to worry about a job since I've had my accounting degree. So
that's another conversation of people. Yeah, you want to.
I mean, we're not chartered CFAs. We're not that level, but.
Oh, from that comment from that guy about yeah, that was funny.
Said we can't read balance sheets. How dare us?
Maybe he'll comment again. I don't know.
He deleted it though.
He deleted his comment.
Yeah.
Oh, I love this comment. Reed Hastings said this: a truly rockstar dev outweighs a mediocre dev by a factor of 100. Netflix pays upwards of $700K for devs because they understand how big of an asset skill, brain power are. Boom. Thank you. That actually adds to the point. So if you have talent that you've identified as being of esteemed quality, and that's the difficulty. Every organization is going to have that level of difficulty of kind of weeding out who's actually good and who's actually bad. Typically in any organization, you could say the square root number of people are doing more than half of the work. And it's almost attributable to any population. The square root number of people are doing more than half of the productivity in any measure. But managing that's tough. It's tough. It's easier said than done. But if you have a methodology internally in the business to identify that and then keep them happy, and your competitors can't, you're at a structural advantage. Chen, how hard is it to get into Meta? I'm curious because you seem to be, I'm assuming you're a software engineer yourself and saying this. How hard is it to get into Meta? Oh, thank you. You guys are just adding more fuel to the fire. So again, I view it as, for myself, a key metric that I try to find in businesses I invest in. Are you having a hard time finding talent and retaining it? If you are, I don't see that as good. I don't see good companies, as ones that make it miserable for their employees. Should make it good for your employees to work there in one of those factors. Either pay them a crap ton to make up for certain other things, or you have other things that are redeemable compared to the pay. Maybe you're not the highest pay, but maybe you got really nice work-life balance. I don't know. You got to make it enticing. Otherwise, you're cooked.
I got to eat dinner.
All right, go for it. I'm going to close off here soon. I also got to eat. Yeah, I'm going to stay on a little bit longer. Well, actually, no, I should end it. I'll go into the club and then just stay on live with the club members. But yeah, because that way I got to put timestamps on this thing.
Yep.
All right. Thank you guys so much for watching, and we'll be seeing you guys on the next one. Oh, if you guys liked this video, like, share, subscribe, check out Dan's channel. He's also streaming this. Follow him on Twitter, follow him on YouTube at Dan Weston. Also, again, check out the links in the description for Gary's articles. If you're curious, check out the club. The link's also down there. If you enjoyed this, again, like. If you're on Twitter, retweet it, heart it, whatever you guys like. That being said, see you guys in the next one. Bye.